Ever get that feeling where the financial markets are just this giant roaring engine and you're trying to figure out which lever does what? One minute you think you've uh, got a handle on it, the next, whoosh, everything changes. It can feel like trying to solve a Rubik's Cube while it's spinning.
Oh, absolutely. It's a feeling many share, I think. The constant influx of news, the rapid price swings. It's so easy to feel overwhelmed. And you start wondering if there's some kind of secret code that only a few people know.
Well, that's precisely what we're digging into today on the deep dive. A listener sent us some really compelling excerpts from Jack Schwager's Market Wizards. This book is almost like a backstage pass, isn't it? Into the minds of some of history's most consistently successful traders. And what's fascinating, cruelly fascinating, is how different their approaches are. Yet they all share this knack for ending up profitable.
Exactly. And that variety is what makes these interviews so insightful.
Hmm.
We're not looking at just one type of trader or, some magic formula. These are individuals who've navigated all sorts of market conditions, traded everything from commodities to currencies, and they learned some really hard-won lessons along the way.
So, our mission today, and we're definitely locked and loaded for this, is to sift through all that experience, to pull out the truly crucial insights. We want to understand what really sets these market wizards apart. Those actionable nuggets of wisdom that you can take away without feeling like your brain just ran a marathon. Okay, let's unpack this.
A really good place to start, I think, is looking at their early experiences. It's quite illuminating. Many of these traders face significant losses right out of the gate, and these setbacks, well, they often prove to be the most valuable lessons they ever received.
Absolutely. There's a story in there about Schweiger himself getting a pretty brutal introduction, wasn't it? In the cotton market, he was using high leverage in futures. And it's important, like the book clarifies, that margin in futures isn't stock margin. It's more like a good faith deposit, right? To cover potential losses.
Exactly. So when cotton prices suddenly shot up, his entire account was just gone, wiped out. And the irony, Schwager notes, is that having more capital might have just led to an even bigger disaster later when prices inevitably reversed.
So the insight isn't just leverage is risky, it's really understanding the specific mechanics of how margin works in different markets. That seems crucial to avoid those catastrophic early mistakes.
Precisely. High leverage acts like a double-edged sword. It amplifies gains, sure, but also losses, as Schwager found out. There's another stark example. The individual who met this character named John promised unbelievable returns, doubling money every 2 weeks.
Wow. That kind of claim should immediately set off alarm bells, shouldn't it?
You'd think so.
Mm.
The listener quickly lost money trading pork bellies with this John character. Didn't even grasp basics like contract sizes or the value of a tick, the smallest price move. And to make matters worse, John's understanding of the pork belly market itself was flawed. The contract months he was trading couldn't even be offset.
Oh, that's bad.
Yeah. It really highlights the danger of chasing those too good to be true promises and the absolute necessity of doing your own homework before you put any capital at risk.
It's a prime example of how just a lack of fundamental knowledge can lead to really painful, swift losses. Then you have the trader who went all in, betting their whole wad, not just savings, but borrowed money too, on lumber. Almost lost everything.
Yeah,
These early trials by fire, as brutal as they were, seem to have hammered home some non-negotiable principles about managing risk.
exactly. These weren't just random bad luck moments. They were expensive, yes, but ultimately crucial tuition fees in the real-world school of trading. They definitely instilled a profound respect for the market's unpredictability and the absolute need for solid risk management strategies. So yeah, consistent theme here. Early mistakes, painful, but foundational for understanding risk.
Okay, so they learned the hard way, they got burned, but how did they then make that leap from getting wiped out to becoming consistently successful? The excerpts suggest finding mentors and developing their own systems played a big part.
That's spot on. The influence of seasoned traders really shines through in several stories. One trader specifically mentions Ed Seykota, a real luminary in the field, as being instrumental early on. Seykota was already pioneering the use of computer programs back then for testing and automating trading systems. Pretty revolutionary stuff for the time.
Yeah, using computers back then, that underscores the power of systematic thinking, doesn't it? Even decades ago.
Definitely. And the excerpts also touch on that turning point for some traders, the shift from losing consistently to finally finding their footing. Interestingly, this often coincided with strong market trends, like the commodity bull market in the early to mid-70s.
Right, so good timing helped.
Well, favorable market conditions undoubtedly played a role, sure, But it's crucial to see they weren't just passively benefiting. They were actively developing skills, refining their methods during that time. One person who started as a floor trader described learning the vital importance of intraday chart points, those key price levels, within a single day.
Okay.
They developed this high-stakes strategy. Take large positions at those levels, but with a really tight safety net. Get out immediately if the trade didn't move their way fast.
So cutting losses super quickly,
Yeah,
decisively.
exactly. And to illustrate that, there's mention of a rule.
Hmm.
Always exit a position on the fourth or fifth limit-up day. A limit-up day means the price hit the max allowed increase. Hitting that repeatedly signals extreme momentum, maybe, but also huge reversal risk.
So it's a way to protect profits during that kind of crazy volatility.
Precisely. These rules, whether learned from mentors or forged through painful experience, they provided a framework, a way to make decisions and control risk, especially when things got unpredictable.
Now, the individuals in market wizards, they clearly operate with a different mindset than, say, the average person just starting out. What are some of the common misconceptions about trading that these guys seem to actively reject?
Well, a major one they consistently hit on is rejecting any notion of guaranteed profits. That anecdote about John and his impossible promises is a perfect example.
Right. If it sounds too good to be true.
It probably is. These wizards understand the market is inherently uncertain. Anyone claiming guaranteed returns, huge skepticism required. They also caution against just blindly following advice from non-trading experts, like, typical brokers. They suggest that leads to more losses than almost anything else.
Wow, that's a pretty strong indictment. It really underscores taking personal responsibility, doesn't it? Doing your own analysis. The book also mentions dismissing the foolish belief in market conspiracies.
Yeah, they seem to operate on the principle that while markets can be irrational, driven by emotion, it's not some hidden group pulling all the strings. They emphasize personal analysis and, interestingly, what many call gut feel.
Gut feel. But isn't that risky?
Well, it's important to clarify. It's not intuition out of nowhere. It's usually the result of years of watching markets, developing this subconscious pattern recognition. There's also a fascinating point about the typical cycle traders go through. Losing, fighting back, cutting back trading, maybe even stopping altogether until they feel they're back on track.
That willingness to step away, especially during losing streaks, that seems like a real sign of maturity. It takes discipline to say, okay, this isn't working, time to pause.
Absolutely. And that open-mindedness, too.
Yeah.
Being able to accept information that contradicts your beliefs or that's maybe emotionally tough to swallow. They aren't afraid to admit they might be wrong and adjust.
Let's delve deeper into risk management and money management. That theme just keeps coming up. What were some of the critical lessons shared in this area?
Well, the severe consequences of overtrading are really hammered home. The story of the trader building up to $30,000, then losing it all on one grain trade, and then nearly wiping out again in lumber.
Oof. Yeah.
It just underscores that fundamental rule. Don't risk too much capital on any single trade. Doesn't matter how confident you feel.
It's that recurring message, don't bet the entire farm, no matter how good the idea seems. There's also a more technical point about spread margins sometimes being unusually low compared to outright contracts, and nuanced traders need to watch.
True. But beyond those specifics, there's this strong, consistent emphasis on meticulously studying price action. To really get a feel for market sentiment, as one trader put it, to understand how everybody is voting with their money.
That's a great analogy. Paying attention to the subtleties of price and volume gives you insights into the underlying forces. And the idea that a big move with little explanation can sometimes be a stronger signal. That's quite intriguing.
Yeah, it suggests maybe less speculative froth and more of a fundamental shift happening.
And it sounds like managing bigger and bigger accounts brings its own challenges. As your capital grows, you're kind of forced into fewer, more liquid markets, right? Where you can actually deploy that size without moving the price too much yourself.
Exactly. Liquidity becomes absolutely paramount as position sizes grow. But maybe one of the most fundamental pieces of advice on money management is just let your winners run. As one wizard said, you can't pay for the losers if you don't stay with your winners.
Simple but profound. You need those big wins to offset the inevitable small losses.
Precisely. Capture those substantial gains when you're right. There's also a brief mention of currency cross-trading, speculating on two currencies, often using the US dollar as the intermediary in the interbank market.
Where the big banks trade, right.
Yeah. And the book touches on the rapid arbitrage between interbank and futures markets when news breaks. Shows how fast things move. And that directive to staff, call immediately if a currency breaks a predefined range, that highlights monitoring key levels.
These details give you a glimpse into the sophisticated strategies these guys use. The analogy of trading as a tremendous multidimensional chessboard
Yeah.
really captures that complexity.
It does. And the discussion around portfolio insurance is important too, explaining it's more like a massive stop-loss order, not true insurance. That's a crucial distinction, especially given its role in events like the '87 crash. It was meant to limit risk but actually amplify the selling pressure.
Because everyone tried to sell at once based on triggers.
Exactly. And ultimately, Market Wizards reminds us trading is largely a zero-sum game. For every winner, there's a loser on the other side. This competitive reality means consistently superior returns likely belong to a relatively small group of highly skilled, disciplined people.
Which sets the stage perfectly for looking at the different trading philosophies and approaches these wizards developed. Because it's clear there's no single magic formula, is there?
Not at all. You see real diversity. Some are comfortable being both long-term investors and short-term traders, moving between time frames.
That shows real flexibility.
It does. And there's a common willingness to short stocks bet on prices falling just as readily as going long. That's not the default for many investors.
And this concept of variant perception comes up. That's really interesting. The idea of seeing market info differently from the crowd. Not just being contrarian, but having your own reasoned perspective.
Exactly. And while understanding the market's general direction is seen as important, they also admit predicting it precisely is incredibly complex, maybe beyond definition, as one put it.
So being contrarian isn't enough on its own. You need a reason for going against the grain.
Right. The book cautions against that. You need a solid rationale. There's a compelling story about traders sticking with positions during big downturns like October '87, even with huge paper losses.
That takes conviction.
Huge conviction. But it also highlights the need to balance that conviction with flexibility. Knowing when you are wrong and need to change course, that balance is critical. Confidence to ride out volatility, humility to admit mistakes, and understanding the person on the other side of your trades, their motivations, biases, that's also emphasized.
We're also introduced to William O'Neill's Cansalem methodology for stocks. That's pretty well known. It's structured, right? Looking at current earnings, annual growth, new factors, supply-demand, leader-laggard, institutional ownership, and market direction.
Yes, CanSlim provides a very specific framework for finding high-growth stocks. It really emphasizes relative strength, how a stock performs, versus the market, and accelerating earnings in leading companies. Those are key. And the methodology advises buying after a stock breaks out from a base pattern, not trying to anticipate it. Wait for market confirmation.
And O'Neill looks for specific volume signals too, right? Especially at market bottoms, like increased volume without further price drops, suggesting buying support is coming in.
Exactly. And O'Neill's famous 7% rule for cutting losses: sell if it drops 7% from your buy price. That's strict risk management. As is the advice to hold winners as long as they perform well. Clear exit rules, both for losers and winners.
That seems essential. The book also strongly warns against averaging down on losers buying more as the price falls.
Absolutely. A classic mistake that often just digs a deeper hole. The book also debunks other common pitfalls. Buying cheap stocks just because they're cheap, relying on rumors, prioritizing dividends over growth.
And there's that critique of Wall Street research often lacking sell recommendations.
Right. Finally, Market Wizards argues the market isn't perfectly efficient or random, mainly because of poorly informed opinions and powerful investor emotions influencing decisions.
Which brings us neatly to personal discipline and mindset. These seem like absolutely crucial themes running through all these stories.
Indeed. The need for constant steady, continuous learning. It comes up again and again. Trading isn't static. You have to adapt. There's also this fascinating balance, sticking to your system, but also having the intuition and confidence to override it at key moments.
That blend of rules and intuition sounds like a skill honed over years. The book also mentions challenges like thin markets, low volume, making it hard to exit bad positions quickly, especially on surprise news.
Definitely. And while rules are crucial, there's this recognition that experienced traders might need to selectively break rules sometimes, evolve their strategies. It's dynamic. Luck is acknowledged, sure, but there's this underlying sense of an attitudinal proclivity for mastery. A deep drive to understand and succeed being far more important long term.
There's that really thought-provoking line, everybody gets what they want out of the market. Wow. That suggests some deeper psychology, maybe unconscious desires or self-sabotage influencing results.
It certainly hints at that. And Larry Haight's story, his unconventional path, his intense focus on quantifying risk shows there's no single right background for success. And Haidt saying, it is incredible how rich you can get by not being perfect. That's powerful.
Yeah.
Focus on robust methods, not impossible perfection.
Yeah, striving for good enough and consistent rather than perfect and erratic. The dismissal of common indicators like overbought, oversold reinforces focusing on fundamentals and risk. And that anecdote about throwing charts on the floor to just look at it,
Mm.
that emphasizes a holistic, almost intuitive grasp beyond just numbers.
Right. And Steinhardt's flexibility being both long-term and short-term, shifting exposure aggressively illustrates adaptability again. For novices, the advice is consistent. Trade small. Focus on the process of making good decisions, not the outcome of one trade.
That seems like solid advice for any learning process, really. Jones's admiration for Eli Tellis and the lesson of moving volume, knowing how to get in and out when the market lets you, speaks to practical realities of size. And Jones's core belief, risk control, is the essence of trading. That message echoes throughout.
It really does. Bielfeld's shifting from grains to T-bonds due to position limits shows how external factors force adaptation. And his use of a trend system as a backup to fundamentals, mainly for exits, that shows using multiple tools. Then you have Sekoda's incredible long-term record with a purely systematic, computer-driven approach, trend following.
Just trusting the system.
Trusting the system, entering on short-term strength in the trend's direction, not picking tops or bottoms. He also highlights varying bet size based on your comfort with potential loss, personalizing risk, and again, acknowledging luck's huge role. Humility, process over outcome.
We don't trade markets, we trade money. That really hits home the risk focus.
It does. The value of trend indicators is noted, but also the limits imposed by managing huge sums harder to get the same percentage returns. And the observation about bear markets, sharp drops, then quick, often misleading retracements, useful pattern recognition.
The insistence on defining your maximum risk point before entering a trade seems universal among them, a non-negotiable rule. And recommending Lefebvre's reminiscences of a stock operator suggests timeless principles endure.
Absolutely. There's that fascinating hypothetical for trainees. What if a top trader is selling, but your analysis says buy? The correct answer: follow your own analysis. Trust your work. Independent thinking.
That's a strong message. There's also the point about managed money's advantage for the manager potential fees without direct loss risk, and the observation about more false breakouts happening now. Interesting contemporary analysis.
Dennis's views on government debt and Keynesianism, while broader economics, show how macro forces matter. The recurring themes: learn from mistakes, don't obsess over daily equity swings, maintain perspective, emotional stability. Jones's intense order style, his flexibility to rapidly change his mind on new evidence hallmarks of adaptability.
And the advice: never risk everything on one trade. Prioritize well-being over chasing huge gains or fearing losses. Emotional discipline again, reducing position size when trading poorly, a practical risk management tactic.
Absolutely. And the story of covering shorts and going long on the close of the '87 crash day. Decisive action against panic. Using the 1929 analogy, analyzing why '87 differed due to credit availability shows complex historical thinking. The mixed success in training suggests maybe some innate aptitude matters alongside learned skills.
Talent plays a role, perhaps?
Maybe. Some express an obligation to share knowledge, feeling fortunate. A generous view. The intensity of winning and losing is acknowledged. It's a powerful profession emotionally. How risk control was permanently forged into Jones's mind after a big loss underscores its absolute importance.
He only thinks about what he could lose, right? Not the potential gain.
Exactly. A powerful risk-first mindset. In contrast, Gelber's relaxed approach despite large positions, yet consistent positive returns with low drawdowns, shows deep mastery. His quote, "I'll probably do better by staying here doing nothing," shows patience when opportunities are scarce. Discipline.
And his belief that no system yet beats a good human trader. Interesting in our automated age.
Very. His observation that failed traders often have big egos, can't admit being wrong, highlights humility's importance. Gelber's reaction to losing streaks reduce size and frequency is just sensible risk aversion. The common pattern: beginners win early, patience, then get overconfident, overtrade, and lose. A cautionary tale.
We've all seen that, I think. The discussion on T-bond liquidity, large trade impacts, practical realities, needing confidence but not letting ego stop you from cutting losses. A crucial balance.
Definitely. And the lack of a specific money goal, focusing instead on process and execution. That's a mindset many high achievers share. The diverse background salesman getting a grub stake from a caddy client shows success isn't limited by starting point. Feelings of failure after early losses, backup plans, shows the emotional challenge.
Yeah, it's not easy. The explosion position strategy, betting on volatility, shows adaptability again. Temporary retirement due to boredom, then returning, suggests intrinsic motivation is key.
Right. Money becoming secondary to the excitement, the challenge, and the importance of thinking through what ifs, planning, not just reacting, proactive thinking. Reinvesting profits consistently is a common wealth building strategy among them.
And the view of success evolving beyond just money to quality of life, a mature perspective.
Investment psychology's role in understanding market and personal behavior is key. That idea some might subconsciously want to lose. Deep psychological territory, common mental hurdles, impatience, anger, fear, over-optimism, acknowledged obstacles.
And the idea you can influence your mental state through physical actions, tangible advice.
Yeah, and the distinction. Winners take responsibility, losers blame externals. A core difference. The interviewer's own story about not profiting enough from a big move shows learning is continuous, daily homework, constant analysis, a relentless theme.
The mention of dreams and trading, though not explored deeply, hints at that deep psychological engagement. And that funny anecdote about calling Carl about the corn market top and getting hung up on shows strong conviction.
Right, and finally, that belief. There's no such thing as a paper loss. Unrealized losses are real, consequential. Manage all positions actively.
Wow. Okay. So wrapping up this deep dive into market wizards, several themes just keep hitting home, don't they?
They really do. The absolute necessity of rigorous risk control and sound money management. That's the bedrock. Cultivating ironclad discipline in following systems, yes, but also in managing those powerful emotions the market throws at you. That's non-negotiable. And the commitment to continuous learning, adapting strategies as markets evolve. Essential for long-term survival.
And maybe just as critical, developing that deep understanding of your own psychology, recognizing biases, strengths, weaknesses. That self-awareness seems just as important as market knowledge. And as we've seen, the path isn't smooth, is it? Setbacks, losses, they're often invaluable learning opportunities.
Ultimately, Market Wizards really drives home that there's no single holy grail trading system, no magic bullet. Instead, it's about that ongoing journey, finding your methodology, one that fits your personality, your risk tolerance, and constantly refining it through experience and really honest self-awareness.
And on that thought, here's something maybe for you, the listener, to consider long after this deep dive ends. Which of these core principles, maybe the discipline in cutting losses, the relentless learning, or understanding your own psychology, which one resonates most strongly with your approach? Not just in finance, but maybe in any area where you're navigating uncertainty, trying to achieve mastery. How do you strike that often tricky balance between conviction in your ideas and the flexibility to adapt when things change? It's definitely something worth pondering.